The Federal Reserve recently made a significant policy shift by reducing interest rates by 0.5 percentage point, reflecting a new approach after a series of consistent rate hikes. This decision highlights the Fed's strategy to balance inflation control with the need to support economic growth and address emerging risks in the labor market. The larger-than-anticipated rate cut shows growing confidence that inflation is under control, but also recognizes the challenges of a weakening job market and slowing economic activity. Since inflation surged to multi-decade highs in 2022, the Federal Reserve had focused on aggressive interest rate hikes to cool demand and slow price increases, aiming for its long-term 2% inflation target. With inflation showing signs of easing by 2023, the Fed was able to reconsider its monetary tightening strategy, culminating in the rate cut in September 2024. The goal is to stimulate borrowing, investment, and consumer spending to maintain economic momentum. However, internal debates within the Federal Open Market Committee (FOMC) revealed differing perspectives on the appropriate scale of the rate cut. While most members supported the half-point reduction, board member Michelle Bowman advocated for a smaller 0.25-point cut, expressing concerns about the risks of moving too quickly, which could lead to renewed inflationary pressures or financial instability. Nevertheless, the larger rate cut was favored, considering the labor market's softening. The U.S. labor market, a strong point during the post-pandemic recovery, has started to cool, with job creation slowing and unemployment projected to rise modestly to 4.4% by the end of 2024. While this increase is seen as part of a broader economic adjustment, the Fed does not anticipate a sharp rise in unemployment or a major downturn. The central bank expects unemployment to stabilize in the coming years. Inflation trends remain a central factor in the Fed's policy decisions. After peaking above 9% in 2022, inflation began to ease, driven by the Fed's aggressive rate hikes. By 2024, inflation was nearing the 2% target, though core inflation, particularly in housing and energy sectors, remained somewhat elevated. The Fed projects inflation will reach 2% by 2026, signaling that price pressures are being managed effectively. Looking ahead, more rate cuts could occur in 2024 and 2025, depending on inflation and economic conditions. The Fed's projections suggest the possibility of up to 2 additional cuts in 2024 and as many as 4 in 2025. However, these moves are contingent on continued improvement in inflation and overall favorable economic trends. Despite global uncertainties and potential financial market volatility, the Fed expects steady U.S. economic growth, projecting an annual rate of around 2% through 2027. This moderate growth outlook aligns with inflation moderation and labor market adjustments. Although growth is unlikely to return to the rapid pace seen in the pandemic's aftermath, the Fed anticipates sustainable expansion without the risks of overheating. In summary, the Federal Reserve's decision to cut rates reflects the challenges of managing inflation, labor market shifts, and broader economic risks. While inflation is largely under control, the Fed is carefully balancing growth support with the need to avoid excessive monetary easing. Further rate cuts remain possible, depending on economic conditions, but the outlook for steady growth remains positive. Thank you for watching.